Bitcoin just hit $72,000, down 42% from its October peak. And according to Bitwise's chief investment officer, this isn't a correction. It's a full-blown crypto winter. Matt Hogan published this on February 2nd, and I quote, "This is not a bull market correction or a dip. It's a full-bore 2022-like Leonardo DiCaprio in the Reverend style crypto winter." And here's the thing about crypto winters. They last about 13 months historically. If this one started in January 2025, we're at month 13 right now, which means we're either near the bottom or we've been measuring from the wrong starting point entirely to begin with. And here's my thesis. What if the 2024-2025 rally wasn't a bull run at all? What if we've entered a singularity moment, a fundamental break from the 4-year cycle, where the old rules no longer apply, and therefore the future is unknowable? What if the real bull run hasn't even started yet? And if that's true, 3 massive forces just converged at the same exact moment, and they're all pointing to the same thing. Liquidity is about to come back. So let's break it down. And in order to unpack this, we first have to talk about and go over what a traditional Bitcoin bull run looks like. The playbook is simple. For those of you who have been around, you know it starts with a halving, when supply gets cut in half, at which point scarcity kicks in, at which point retail FOMO builds, and at which point price goes parabolic, which introduces a blow-off top, and then the market crashes. So 12 to 18 months after the halving is when we typically expect the peak. And this has happened 3 times before, in 2012, in 2016, and in 2020. The 4-year cycle was gospel. But then came 2024, which broke the pattern. And I think most crypto OGs, everyone who's been around for at least a cycle or more, accepts this, I think, hopefully at this point, to be true. Because it's just obvious. If you connect all the dots, it makes sense. And here's what changed everything. And it happened in 2024. Bitcoin spot ETFs launched. $113.8 billion in institutional assets under management within a year. BlackRock's IBIT alone holds over 800,000 Bitcoin. That's 3.8% of the total supply. That was our singularity moment. The moment Bitcoin fundamentally changed and broke away from the 4-year cycle. Because here's what the ETF did. Bitcoin's volatility didn't explode. It compressed by 55%. So instead of wild swings, we got institutional dampening. And Bitcoin's correlation with the S&P 500 increased. It stopped acting like a pure scarcity asset, and it started acting like a leveraged macro asset. And the 4-year cycle, broken, because the fundamental conditions affecting Bitcoin, the supply and demand dynamics, the market structure, the types of buyers, all changed in January of 2024. So we therefore can't predict Bitcoin's future the same way we did in the past anymore. The old models don't work. The old patterns don't work. Not all of them anyway. We're in uncharted territory. And this is exciting, actually. And this is what I mean by singularity. We've crossed a threshold where we cannot foresee exactly what the future looks like. But we do know it's fundamentally different, and different in a good way, for the most part. And here is what we also do know happened. Bitcoin hit its all-time high in March of 2024, before the halving. And that has never happened before. Every previous cycle, the all-time high came 12 to 18 months after the halving. But this time, ETF demand front-ran the entire supply shock. So that was the first force that created the appearance of a bull run. The second is Trump actually delivered on his crypto promises, and he's still in the process. In January of 2025, Trump took office. And unlike most politicians, whether you love him or hate him, that's separate, okay? He actually did and has done what he said he would do. He signed pro-crypto executive orders. He appointed crypto-friendly personnel across all the relevant agencies with people who actually understand crypto technology. And he has recently nominated Kevin Warsh, a serious, credible figure with Fed experience, to lead the central bank. Mind you, on that point, it's important to note that it's not a done deal. There is a process that could take weeks to months in actually getting him to become the new Fed chair. There's a journey. He has to be voted on by the Senate, I believe. Anyway, the point is Trump has created the Presidential Council of Advisors for Digital Assets. He talked publicly about a strategic Bitcoin reserve. And these were not empty promises we have come to see. These were real policy actions he has taken. And the market reacted, and favorably. So price pumped multiple times, giving us the appearance of a bull run. So when I say we have not truly had a real bull run, quote unquote, I don't mean Trump didn't deliver. He did. What I mean is these were policy-driven pumps, the Trump effect, not a truly organic, liquidity-fueled macro bull market that the 4-year cycle predicted. The difference? Policy pumps are fragile, and if anything, they don't last. They don't have fundamental support. They depend on continued execution and political will. And when policy stalled, as it has with the Clarity Act, which got deadlocked over stablecoin yield when the government shut down for 4 days and caused price to collapse, which we're still also in the middle of. Then came the third shock, Trump effect. That is the Warsh nomination market impact, which I also covered in yesterday's video and Monday, I believe. January 30th, Kevin Warsh, the former Fed governor, the inflation hawk, the Milton Friedman disciple, got officially tapped to replace Jerome Powell. The market's reaction? Well, the dollar surged, which fundamentally is good for the US. But it also meant everything priced against the dollar got destroyed, like Bitcoin. Silver fell 31% in a single day, its worst drop since March of 1980. And gold dropped $1,000 per ounce from its peak of $5,600. And as I was saying, Bitcoin also fell. It fell to $72,000, down 42% from its October high of $126,000. Why? Because the market decided Warsh would restore Fed independence, which is actually good, as I was saying, long term, because it means the Fed remains credible, which means when they do cut rates and expand liquidity, it works. But short term, okay, it killed the anti-fiat trade. The whole dollar collapse, buy gold, buy Bitcoin narrative just evaporated. So here's my continued thesis. The ETF turned Bitcoin into an institutional asset and broke the 4-year cycle. We entered into the singularity, as I was saying, a fundamental shift where the old rules no longer apply and we can't therefore predict the future in the same way. The cycle may now become a 5-year cycle. We may go into a never-ending pump, which I actually have reasons to believe may happen, with some ups and downs and corrections along the way, but I think we're going up only. And once again, let me know if you want me to cover this in detail in a separate video. Anyway, the point is Trump delivered real policy wins that pumped the market multiple times. Those were legitimate catalysts, but they were policy dependent and not driven by the macro liquidity expansion that creates sustainable bull markets. And we never got the actual macro conditions for a traditional bull run, meaning no sustained global liquidity expansion. M2 money supply was still contracting through most of 2024. There was no regulatory clarity. And now the Clarity Act is still stuck. So we haven't seen organic retail mania. There's been no euphoria and therefore no blow off top. No everyone's talking about crypto moment yet, but it will come. That said, we've been in a bear market. I believe we've been in a bear market that has looked like a bull run. And now the illusion is breaking. We're in the singularity. The future is unknown. The old cycle is dead. But if we're still waiting for the conditions that start a real macro bull run, those conditions might be converging right now. I'm highly optimistic, and here's why. But first, it's important to really hone in and emphasize something. And that is that while ETFs gave institutions access to Bitcoin and indirectly introduced them to the crypto world, it's important to remember and realize that no institution deploys serious long-term capital without regulatory clarity first. That said, the Clarity Act is the infrastructure unlock. It is the green light that tells Wall Street you can build here now. It is the key. And so far, if you watched my yesterday's video, which I would encourage you to go watch if you haven't, the Clarity Act has been stuck on one issue, that is stablecoin yield. And here's a quick version of what's going on. If you want the full breakdown, once again, go watch yesterday's video. But the bottom line is this. Banks don't want crypto platforms or exchanges like Coinbase offering yield on stablecoins. They say it drains deposit, it competes directly with them. And crypto says, well, that's the whole point, to give users access to market rates instead of the measly 0.01% banks pay on savings accounts right now. February 2nd's meeting led to no breakthroughs. Banks were described as rigid, and the White House ended up setting a deadline. They have to figure it out by the end of February. So I'll be tracking that closely and letting you know here at my channel, so you may want to stay tuned. And then something interesting happened. Donald Duong, I hope I'm saying his name right, Coinbase's head of global research, gave an interview and said the following. He said, I still think that it's possible, aka the Clarity Act, will pass in 2026, this year. I think that there's also a lot of compromise that people are starting to offer here. And this is where I'm heading into the interesting, juicy part of my video. Compromise that people are starting to offer here. Now, this is notable because this is coming from Coinbase's institutional division, the part that actually works with traditional finance. So he's basically saying he's seeing a compromise forming. That's a signal, because here's the thing. This exact fight has happened before, and the solution was partnership, not war. So that's what I foresee happening. And in order to help you see what I see, let me take you back to the 1970s. At the time, banks were fighting a new financial product called money market funds. Regulation Q capped the interest banks could pay on deposits at 5.25%, but inflation pushed market rates way above that. So in 1969, two guys, Bruce Bend and Henry Brown, created the Reserve Fund, the first money market fund. It offered savers market rate returns, and depositors fled from banks in droves. The banks lobbied hard. They said money market funds would destroy banking. Sound familiar? They said it would drain all the deposits, that it would kill lending to families and small businesses. But here's what actually happened, and I can see this happening again. The banks were forced to adapt. And in 1980, the Depositories Institutions Deregulation Act phased out Regulation Q's rate caps. By 1982, the Garn Street Germain Act allowed banks to create money market deposit accounts. And critically, banks partnered with money market fund providers. They white-labeled products. They earned fee income on custody, compliance, and settlement. Money market funds grew into a $6 trillion industry, and banks didn't die. They adapted and took their cut. And this model is already happening with stablecoins. BNY Mellon partnered with Circle, the issuer of USDC. The bank handles custody and redemption infrastructure, and Circle handles distribution. Both take a fee cut, and that's how both can win here. Both the central banks and crypto exchanges and platforms. We also see that Cross River Bank partnered with Visa. The bank settles USDC transactions for Visa and earns settlement fees. We also see that Stripe acquired Bridge for $1 billion. Stripe's USDB stablecoin is backed by BlackRock money market funds. It generates yield, and Stripe takes the payment orchestration cut. Banks hold the reserves and earn fees. So the compromise is already clear. Banks provide regulated infrastructure, custody, AML compliance, reserve management, and crypto platforms handle distribution and user experience and technology. Revenue splits via fees, not deposit interest. This could be a reality for us today through the Clarity Act. And as I said, this is exactly what has happened before in the past. So we have precedents. And once again, this is what we already see happening with BNY Mellon and Circle and Stripe and Bridge. So hopefully we see some compromise where the banks can get a cut and crypto gets to innovate, which is what we're so good at here in the crypto space. And in the end, users hopefully should also get better rates. And once again, the deadline is the end of the month, February. So if the Clarity Act passes with this partnership model, as I can foresee, we'll see if I'm wrong. My thesis, my premise here is that regulatory certainty would unlock. infrastructure would become operational, and the capital that has been sitting on the sidelines waiting for that green light would deploy. So that's the catalyst I believe we've all been waiting for. But here's the thing, okay? The Clarity Act isn't acting in a vacuum. There are two other major massive forces that are hitting us at the same time. And not to sound hypey, but actually, almost no one's talking about it. Today, February 5th, the last remaining nuclear arms control treaty between the United States and Russia officially expired. The new Strategic Arms Reduction Treaty, or New START acronym, used to cap both countries at 1,550 deployed strategic nuclear warheads each. It included inspections, verifications, and a direct communication channel. But as of today, those limits are gone. There are now 0 legal restrictions on how many nuclear weapons the US and Russia can build. So this is the first time since the early 1970s that there are no legally binding caps on US-Russian nuclear arsenals. Both countries have over 5,000 total warheads in their stockpiles. No inspections, no verifications, no safeguards. And last year, in September of 2025, Putin offered a 1-year informal extension to the US, basically. He said, and I paraphrase here, let's both agree to the US, he said this, to follow the limits voluntarily for another year while we figure this out. And at the time, Trump said, it sounds like a good idea, then walked it back in January. If it expires, he said. We'll just do a better agreement. No negotiations underway. But we haven't heard of any negotiations underway. Let me know if I'm wrong or missed anything. And as of now, China refuses to join arms control talks unless the US and Russia cut their arsenals first. They argue their 600 approximate warheads can't be compared to the superpowers' 5,000 plus warheads. And they have a point. And in April this year, 2 months from now, the Nuclear Non-Proliferation Treaty Review Conference begins. Nuclear powers are supposed to demonstrate progress on disarmament. And instead, as of now, they're demonstrating the opposite, all as the last treaty just died today. And why do I bring this up? Not just to terrify you, but it matters for markets. And I believe, based on Trump's past track record and his negotiation style, this is probably underway, and we will probably hear updates today, potentially before my video is released. So be aware of that. But as of now, I bring this up because this implies a geopolitical risk premium, and it will reprice. Defense stocks will rally. Safe haven demand, such as gold and Bitcoin and volatility products, will increase as investors price in a world without nuclear arms constraints for the first time in 50 years. Tell me yes or no if you agree with this. What we're seeing is an existential shift happening in real time, and hardly no one is talking about it as of the time of my video. Hopefully more people are by the time it's published. So that's force 1, okay? Force 2 is the whole Kevin Warsh and the liquidity paradox situation, which I covered in greater detail yesterday and Monday. In the short term, Warsh's nomination caused pain. The hawkish signals sent the dollar soaring, and in turn, it killed the anti-fiat trade. Gold, silver, and Bitcoin all got destroyed, okay? All as the 4-day government shutdown early this month compounded the liquidity drain because everything stalled. And Charles Henry Monchot, I hope I'm saying his last name right, the CIO at CIS Group, said it perfectly. Markets are addicted to liquidity, and currently this is the biggest stress, he said. But here's the paradox I want to get into. In the long term, Warsh restores Fed independence. And markets actually want that because an independent Fed means credible monetary policy. And credible monetary policy means when they do cut rates and expand liquidity, it actually works. And the market believes it. And we know that the Fed already started cutting in September of 2024. They've paused the rate cuts, but they haven't reversed them. And more importantly, quantitative tightening, the process of shrinking the Fed's balance sheet and removing money from the market, is expected to end sometime this year. And while the M2 money supply bottomed in 2023 and is starting to turn back up, we see that global liquidity, which is measured across the US, China, Europe, and Japan, is inflecting positive. The liquidity stress is peaking, which means the turn is close. That's force 2. And force 3, of course, is the Clarity Act deadline, end of this month. And as I was saying, this is speculative, okay? But I'm explaining to you why. I believe we could very well see, this is me calling it, a bank and crypto partnership model underway and coming soon. We'll have to see if I'm wrong or right. And as I was saying, we do have historical precedents from the 1980s showing that this works. And if it passes, okay, regulatory certainty will unlock and institutions will deploy serious capital. It will be game on, especially for the DeFi sector. So now let us pull this all together. In conclusion, all right, the last nuclear treaty expired today. Geopolitical risk premium rises and safe haven demand returns. Gold, Bitcoin, and defense stocks. All as Warsh signals Fed independence. He was a very strategic pick by Trump, if I could say so. And in the short term, yes, that's painful because strength is returning to the dollar, which is ultimately really good for the US and for national security. But long-term credibility means the coming liquidity turn actually works. And as I was saying, we may very well see a Clarity Act passing by the end of the month, if not sooner. And with it will come regulatory clarity, and institutional capital will deploy because of it, which will pump the crypto markets. And if we add to those factors the fact that quantitative tightening ends this year, meaning M2 or the global money supply will start growing again. So if Bitwise was right in saying that this has been a crypto winter's last 13 months as our historical reference, and if it's true, January of last year, 2025, was month 1, meaning we'd be at month 13 now. So this may very well be our bottom. And what follows after a bottom? Well, a pump. All we need is a catalyst, which brings us to the question we should be asking right now. What should we actually be watching? So here are the signals that matter and that will inform what happens next. Signal 1, whether or not the Clarity Act is passed. If it passes, as I was saying, this is the single biggest crypto catalyst of 2026. Regulatory certainty unlocks infrastructure, and institutions, as I was saying, will deploy capital they've been holding back. But if it fails, we have to be fair here, will be an extended limbo. Institutions will stay on the sidelines with their capital, and we could foresee another year of uncertainty, which I think is not likely to happen, but I have to cover it for the sake of being level-headed. But as I covered in today's video, David Wong's optimism from inside Coinbase's institutional division suggests passage of the Clarity Act is more likely than the market thinks. So watch for the vote. Signal 2 we need to be watching is Bitcoin's $58,000 level. Galaxy Digital's Alex Thorne flagged the 200-week moving average at 58,000. And historically, if we can count on this pattern signal or price point, this would historically be where Bitcoin bottoms form during bear markets. And if we test, according to him, the $58,000 mark and hold, the bottom would be confirmed, accumulation would begin, and we could see a pump from there. But if we break below this $58,000 mark, according to him, we could see deeper capitulation before the final low. And signal 3 would be global liquidity, the M2 money supply. And right now, it's currently inflecting positive after bottoming in 2023. So once again, we could see a pump from here. And then once again, watch the Fed's quantitative tightening timeline, expected to end Q1 to Q2 of this year. Remember, liquidity leads Bitcoin by 6 to 12 months historically. So if liquidity turns on now, Bitcoin follows or should follow by mid to late this year. 2026. And signal 4, which we covered lightly today, would be defense stocks. Lockheed Martin, Northrop Grumman, Raytheon. If these rally hard while the broader market stays flat or down, The geopolitical risk premium is pricing in. The nuclear treaty expiration today will drive this over the next coming months. And then signal 5 are the ETF flows, of course. Watch for sustained inflows resuming into Bitcoin ETFs. BlackRock's IBIT is the bellwether. It's the largest Bitcoin ETF by assets. Sustained institutional inflows mean big money is positioning for the turn before it's obvious to retail. The next 60 to 90 days tell us which timeline we're in. The best case scenario, once again, is if the Clarity Act passes. Liquidity turns and Bitcoin holds above the $58,000 mark because institutions would deploy at this point and the actual macro bull run would start. And the worst case is if the Clarity Act fails, liquidity stays tight, and Bitcoin breaks below the $58,000 mark, which I don't think we will do. And this would mean we're in for a grind throughout the rest of the year. Either way, we will know soon. So as we close out, here's the bottom line. Bitwise called it a crypto winter, and they're probably right, but not because the bull market ended, but because it never started, at least not the traditional macro-driven bull market the 4-year cycle predicted, because we hit a singularity moment. The ETF fundamentally changed Bitcoin. The old cycle is dead. The future is unknowable and in the most exciting ways is what I believe. So we can't predict what comes next using the old models. But we do know this. The 2024-2025 rally was a combination of ETF institutional front-running and Trump actually delivering on policy promises. Those were real. They pumped the market, but they weren't driven by the macro liquidity expansion that creates sustainable bull runs. We know this. And now 3 forces are converging. That's what today's video was all about. The last nuclear treaty expired. Warsh restored Fed credibility. The Clarity Act is now at the finish line. Liquidity is returning, and Bitcoin is near its 200-week moving average, where bottoms historically form. So we see the setup is forming. If the Clarity Act passes by the end of this month and liquidity continues to inflect positive, this isn't the end of something, it's the beginning. We're in the singularity moment now. The old rules are broken, but the new rules might be forming before our very eyes. So the question is, are you positioned for what comes next? Follow me for Clarity Act updates, because the next 60 days will change everything. I love you guys so much. Let me know what you think in the comments. I loved hearing from you yesterday, and I will catch you guys here tomorrow.